While many like the S&P 500, and I certainly do too, as a long-term compounder, especially if you combine to a low-cost, passively managed S&P 500 index fund like VOO or SPY, it's a pretty sound way to go, especially if you just have a long time to let your money compound. You don't want to spend time on investing. It's not your passion, and you just want to put money there consistently on a dollar cost averaging basis. It's pretty hard to beat. However, if you're looking at actively managing your portfolio and you're focused on trying to outperform the market each year based on how you're positioning your portfolio, maybe you want to take a different approach. And I think of any time in my lifetime, right now is probably the most opportunistic time to look elsewhere beyond a passively managed index S&P 500 fund. And in this video, I'm going to detail why, and I'm going to share with you one fund in particular that yields about 12% that I think is well positioned to outperform the S&P 500 this next year. Before I get into the video though, if you could please subscribe to my channel to get future content. I talk about dividend stocks, I talk about dividend ETFs, I talk about dividend CEFs, I just talk about the art of dividend investing in general, put out several videos each week quite consistently. So again, if you'd like a pathway to better dividends and better dividend investing, please subscribe to my channel. Thank you so much. Okay, so let's get into this video. What is the fund I'm talking about here? Well, it's the NEOS S&P 500 High Income Fund. It's ticker symbol SPYI, unlike, in contrast to SPY, which is the ticker symbol for the popular S&P 500 index. So it's, again, SPYI, not SPY, and just think of I for income. It's basically, when you look at it, the underlying holdings, whether it be the sector exposure or the individual holdings, it very closely mirrors the S&P 500. The only real difference between these two funds is that SPYI employs a monthly covered call strategy that it uses to generate what it targets about to be 1% in monthly options premiums on its principal that it pays out each month. It turns into about a 12% annualized yield. Now it employs these options sales strategically, and it also uses Section 1256 contracts, which are treated more favorably on a taxation basis than many other options that similar options writing funds use, such that 60% of the options profits are taxed as long-term capital gains and only 40% are taxed at short-term capital gains or ordinary income rates. And so it is a little bit more of a tax advantage fund than some of its peers are. Of course, it does charge a 0.68% expense ratio, which is well above what SPY charges, for example, at just 0.09%. So that is a big advantage for SPY. And again, to be clear, I think over many, many years, I think SPY is likely going to outperform SPYI simply due to the lower expense ratio and the fact that covered call funds like SPYI that just sell blanket calls like this, they tend to underperform over the long term because, again, they miss out on these strong bull runs that the market can take on and get left hopelessly behind. And yes, they outperform when the downturns and the flat periods, but it takes a lot of those for it to catch up when it misses on those sudden sharp spurts higher. So when you consider that with the power of compounding, I think that SPY is likely to outperform SPYI over the very long term. But for this next year, I think SPYI on a risk-adjusted basis is more attractive than SPY is, and the rest of this video I'm going to discuss why. The reason for this really simply is the fact that if you look at the underlying holdings of the S&P 500, namely these mega cap technology stocks that make up about a third of the index, many of them are very overvalued right now based on just about any traditional valuation metric. Stocks like Tesla, Microsoft, etc., they all have pretty much all of them have very high PEG ratios, which is price to earnings with the growth factor taken in. Basically what that means is that the market is pricing in very, very aggressive growth expectations for these stocks, much more so than they're likely to be able to achieve. Their market is so bullish on AI that they pretty much priced in a best case scenario that the technology is going to cause a boom in earnings for these companies, and it may well do so, but they're saying it's going to happen pretty soon based on the valuations. So again, right off the bat, your odds are tilted against you there as an investor in SPY over the short term at least. And on top of that, you have growing macroeconomic risks, growing geopolitical risks, especially with the growing threat of war in East Asia. The war in Ukraine continues to rage on. Tensions in the Middle East continue to soar. And so there are many potential catalysts to send the market lower. You have the Fed now wavering on its rate cutting program, long-term interest rates rising. You have uncertainties about tariff policy, that what exactly Trump is going to implement there when he takes office. And so there are so many reasons to be cautious, especially in the near term over this next year, of how the S&P 500 is going to perform. And even when you look at not just the individual top holdings, but the overall market valuation, numerous models such as the Buffett indicator, the S&P 500 mean reversion, the S&P 500 price earnings ratio model, and others, they all point to the market being significantly overvalued right now. So why do I think that SPYI is well positioned to outperform SPY? After all, over the past year, SPY has significantly outperformed SPYI because all the AI boom in its underlying holdings has sent it higher, while the covered calls in SPYI have capped its upside on these strong rallies. Well, you don't have to look back that far. If you just look at the first year of SPY's existence, which was mid-2022 through mid-2023, it actually outperformed the S&P 500. And the reason for this is simply because at the time, especially the first half of that period, the AI boom had not kicked off yet. In fact, many of these mega cap stocks were kind of in the doldrums. They were significantly underperforming. And so SPY outperformed. Again, why? Because it was selling monthly covered calls, and that gives them a more stable sequence of returns. You're giving up the potential for significant upside in exchange for a more consistent, stable sequence of returns because that monthly cash flow is coming in. If the index doesn't rise by very much or at all during a month, that cash flow that it generates on the options income is free money that literally print. It's like printing yourself a free dividend every month if there's no appreciation. If there's a strong rally, though, you're giving up some upside in exchange for that income. And so you could actually end up behind if you follow that approach. And so that's why I think that SPYI is going to outperform SPY this next year, because I think that there's a greater than not odds that the market is going to probably trade flat or even down this year because of all these uncertainties, the rich valuations, etc. And again, who knows? No one knows exactly what's going to happen this year. But even if the market continues to have a good year, I think SPY obviously is going to still do well. It did well this past year because it's still going to get some upside. It's still going to get that options income. And so what are the chances that SPY, what room does it logically have to run significantly higher in the near term? It doesn't seem like very much to me. And so as a result, I think in the likely range of scenarios, the vast majority of them are going to result in SPY either performing very close to SPY or outperforming it. Again, I could be wrong, and I wouldn't, bet the farm accordingly. But again, worst case scenario, SPY outperforms, you're still going to do fine at SPY. So again, this is why I think that 12% yielding SPYI is a better buy right now than SPY is. Now, personally, how am I investing? I don't invest in either because I pick my own individual stocks. And so I don't have to worry about that sort of thing. But I think if you're an index investor, you want exposure to the S&P 500, but you want to maximize your risk reward. Maybe you're getting a little concerned about the rich valuations. You want to hedge a little bit against potentially a flattish year. I think SPYI is a compelling option right now, again, because it gives you the same underlying index exposure, but you write covered calls. It gives you that more stable sequence of returns. So again, hopefully this video is helpful to you. If it was, give it a like. Subscribe to my channel for future content like this, as well as content on individual dividend stocks that I put out quite regularly. Thank you so much. See you next time.